about an investor, you're probably picturing someone nearing retirement, or maybe someone driving a six-figure sports car. But the reality of building wealth looks like a 20-something taking the bus to work. You do not need a massive salary to enter the market. The first step is recognizing the difference between saving and investing. Saving protects your capital, keeping it in a safe, accessible place for emergencies. Investing puts that capital to work, specifically so it can grow. If you just leave all your cash sitting in a checking account, it actually loses value. Because of inflation, the cost of living goes up every year. The groceries and rent that cost you €100 today will cost more next year. Keeping your money completely idle guarantees a loss in purchasing power. To actually build wealth, your money needs to earn a return that outpaces that rising cost of living. The mechanism that makes this possible is called compound interest.
This happens when the money you invest earns a return, and then those new earnings start generating their own earnings, stacking on top of each other year after year. This graph shows the stacking effect. Investing €50 monthly from age 20 grows exponentially, reaching €200,000 by age 60. Now the second line, waiting until age 30 to start that same investment yields only €100,000. Delaying your entry into the market by a single decade costs you half your potential wealth. Time performs the heavy lifting in wealth creation, proving far more influential than the size of your initial deposit. Knowing that time is on your side is great, but it doesn't solve the immediate problem. If you are on a tight budget, how do you actually find the cash to invest? You have to track your income and organize your expenses. Before you buy a single stock, you need a budget. This chart breaks down a highly effective model, the 50-30-20 rule. You allocate 50% of your income to absolute needs, like rent and groceries. 30% goes to wants, like going out. The final 20% is dedicated directly to savings and investments. By mapping out your monthly cash flow, you can identify a few unnecessary expenses to cut. Redirecting just €10 to €25 a month from your wants category is all it takes to make your first investment. Once you have that money set aside, you have to decide where to put it. Every financial market operates on a single central rule, the balance between risk and reward. On one end of the scale, you have assets like high-yield savings accounts and government bonds. These are highly stable, but they offer modest returns. They are safe places to park cash, but they grow slowly. On the other end, you have equities like company stocks and real estate, and digital are extremely volatile. Their prices can drop suddenly and severely. When we talk about risk, we aren't just talking about picking a bad company. Risk means your entire portfolio could lose value because of a global economic recession, rising interest rates, or sudden political instability. You protect yourself using two strategies. The first is diversification, spreading your money out across different types of investments, so a loss in one area is balanced by a gain in another. The second is asset allocation, which means choosing the right mix of safe and risky investments based on when you'll actually need the cash. Smart investors do not try to avoid risk entirely. They distribute it. You take on higher risks when you have decades to recover from a downturn, and shift to safer assets as you approach your financial goals. So you have a budget and an understanding of the assets available to you. How do you actually buy them? Today, you access these markets digitally. Mobile investing apps give you direct, user-friendly access to the stock market, letting you pick and choose your own assets. Alternatively, robo-advisors use algorithms to automatically build and manage a diversified portfolio for you based on your personal goals and risk tolerance. Before you download anything, check the platform's regulatory status to ensure your money is legally protected. Look for their minimum deposit requirements and read the fine print to find out exactly how much they charge for trading and account management. The barrier to entry is lower than ever, but if you choose a platform with hidden fees or high management costs, those charges will quietly devour your compound interest over the years. Building wealth takes patience and a methodical approach. That reality contradicts the constant noise seen online, where financial influencers aggressively promote the next big trade. You have to know how to spot a scam. If an opportunity promises guaranteed high returns or pressures you to act quickly before the window closes, walk away. Legitimate investing carries risk, and it never requires you to rush. Use a simple checklist for online financial advice. Is the speaker qualified? What is their motivation? Are they teaching you or just selling a course? True financial independence grows from a foundation of consistent budgeting, sharp critical thinking, and the simple choice to begin today.